Now we're going to solve a question related to cash budgeting. Now this question says that the BPL Corporation is preparing a cash budget for June 2018 and has provided the following information. They have provided you the each month sale. 70% is going to be on credit and 80% will be collected in the month of sale. The remaining amount is collected in the following month. Then they have told you that the cost of goods sold equals 70% of sales. Of all purchases, 70% are paid in the month of sale and 30% in the following month. The company's policy is to maintain an inventory level equal to 40%. Selling and admin expenses are budgeted rupees 10,000. For June, they included 3,000 of depreciation. This is the cash balance at June 1st. These are the sales for May, June, and July, and the May purchases are 67,860. Now, the requirement is to prepare a cash budget for June 2018. Okay, so this is the information that is provided, and we're going to make a cash budget over here according to this information. So the May, June, and July are the months for which the information is provided. The first thing that we should use is the sales amount. So the amount for sales, let me just zoom in. The amount for each of the sales provided to you is 84,000, 124,800, and 108,000. So I've taken these three values. Now the credit sales amount. So of the month sale, 70% are on credit. So of the month sale, 70% will be on credit. That means 70% of 84,000 will give you May's sales. Similarly, you will get the June sale by 70% of the June amount, and 70% of the July sales is on credit. So these are your credit sales amount. Now, with 80% of the account being collected in the month of sale, the remaining amount is collected in the following month. We will come to this later on. First, we're just trying to gather all of the information. Now, the cost of goods sold equals 70% of sales. So now we are going to look at the cost of goods sold, which is also 70%. Now, 70% of the sales amount is your cost of goods sold. 70% of your sales amount. So we have multiplied each of this in this case. Now, of all purchases, 70% are paid in the month of sale and 30% paid in the following month. For this, you will have to also calculate the purchases amount. So let's see what other information is provided to us. The company's policy is to maintain an inventory level equal to 40% of the next month's sales requirements. This is also something that information is given directly. You can derive it from sales. So whatever you can directly derive it from sales, first we're calculating that. So the inventory level is 40% of the next month's sale. So for the June sale, you're going to keep a 40% inventory right now. For the next month's sale, you're going to keep a 40% inventory in the current month. Similarly, for the July sale, you're going to keep a 40% inventory in June. Selling and admin expenses are budgeted. Again, this is directly related to your cash flow. We'll come to this later. Now that you have the cost of goods sold and the inventory level, you can figure out the purchases amount from this. You can see that the May purchases have been provided to you, so you can plug this in. But you need to figure out the June purchases. Now for that, we're going to use an accounting formula. Basically, your cost of goods sold is equal to your opening inventory plus your purchases minus your closing inventory. So now let's see what are the values that we have for June. For June, we have the opening inventory. June's opening inventory is going to be the May's closing inventory. This inventory will open in June. So the opening inventory is 49,920 plus the purchases amount we do not know because we're trying to figure this out for June. And the closing inventory for June is 43,200. What about cost of goods sold? You have the cost of goods sold for June as well. So this is 87,360. Now you just have to calculate the purchases amount by simply shifting everything else on the other side. And plus 43,200, you will get the purchases amount. So the purchases amount is going to be and now that we have this value, we're going to insert it over here. These are the purchases for June. So far, we have not calculated anywhere what is the cash outflow or the cash inflow. We have simply gathered all of the data. Now we're going to begin estimating the cash inflows and cash outflows. So the cash inflows are going to come from the sales amount. How are they collecting their sales? So over here it is written of the month sales, 70% are going to be on credit with 80% of the account being collected in the month of sale. Okay, so if each month sales, 70% are on credit. Now, if 70% are on credit, that means 30% will be on cash. So for 30% of the sales amount, you will get immediate cash payment. 30% of the amount, you will get immediate cash payment. So of the sales amount, 30% you're going to get immediately in the form of cash and 70% will be in the form of credit. Now of this remaining 70%, it's written that with 80% of the account being collected in the month of sale. So of this 70%, 80% will be collected in the same month. So amount collected in the month of sale is going to be 80% of the credit sales amount. Then it's written that the remaining amount is collected in the following month, and the remaining amount that still needs to be collected. So if 80% is collected, then 20% still needs to be collected, or you can simply subtract it. So here you go. In the subsequent month means in the coming month. So the credit sales of May, 20% of this will be collected in June, and similarly, the June one will, the 20% of this will be collected in July. So with this, we are done with our cash inflows. Now we're going to begin with our cash outflow calculations. So in our cash outflows, we have purchases amount. Now, if you read about purchases, it's written that of all purchases, 70% are paid in the month of sale and 30% are paid in the following month. So you have the purchases amount, 70% are paid in the same month and the remaining 30% will be paid in the next month. So the amount that will be paid in this month so 70% will be paid in this month. So 70% will be paid in the same month. And 30% will be paid in the next month. So the amount of May will be paid in June. And the amount of June will be paid in July. So this was about purchases. Then over here it is also written that the selling and admin expenses are budgeted 10,000 and this includes 3,000 depreciation. Because you're making a cash flow statement, you do not have to include depreciation in it. It is a non-cash expense. So after removing depreciation, the selling and admin expenses that are being deducted in the form of cash will be 7,000. So these are your total cash outflows. Now this is your cash inflow and this is your cash outflow. So that means you have a net cash inflow of, not outflow, it's an inflow because the amount will be positive. The net cash inflow is this much. The opening cash balance was 26,000. Sum both of them up and you get the closing cash balance of 61,282. So this was your June's cash balance. You were supposed to make this only for June.